So if you've been following our channel for a while now, you know that we typically like to talk about 0% interest credit and how best to utilize it for your business. But with the banking industry really going through it right now, with things like interest rates on the rise and many consumers talking about their credit limits being lowered, the question comes up, how much longer are 0% credit offers really going to be available? So today we're going to cover whether banks are going to continue to give out 0% interest business credit, as well as share some tips we give to our clients to ensure you aren't affected by everything that's going on in banking today. Now, before we begin, I want to give a shout out to Joe Z, a subscriber of ours who left this very comment that inspired this video. So you're going to want to make sure to subscribe to our channel to get updates on everything that's going on in the banking industry, as well as all things business credit. And with that, let's go ahead and get into the video. So before discussing whether or not they're going to continue being offered, let's review why banks offer 0% cards in the first place. They do it to expand their customer base, to encourage more spending, to extend their brand recognition, and really to encourage switching, with 0% kind of going hand in hand with balance transfers. You know, customers are typically pretty reluctant to switch banks unless they're provided with a real incentive to do so. And so 0% offers can be that incentive to sort of switch teams. So when I'm talking to clients about, well, what's in it for these banks to really give these 0% out, it's because they're going to be making money off of you one way or the other. That's ultimately what this is. Now, keep in mind that interest rates are not the only way banks make revenue off of their clients. Another option that puts money in banks' hands is just straight up annual fees. So even if the 0%'s there to get you in the door, there may be an annual fee that you're going to have to pay every year. They also get a kickback from merchants who use their card. So that 0% encourages spending from the client, and the merchants have to kick back something else to the banks. Not to mention there's also penalties and late payments. So it's safe to say that banks have more than likely studied borrower behavior and found that many borrowers start out optimistic about repaying everything, but oftentimes get caught with penalties later on. So now that we know why they initially give out 0%, we can realistically look at whether or not they're going to continue offering 0% options for the future. So first off, as long as banks can use these kind of offers to get new customers, as a marketing effort, and to make money, I don't really see them getting away from 0% offers anytime soon. Even if the general public grows more nervous about bank stability, thanks SVB, it would be literally bad business for the bank lenders to completely cut off a stream of income like 0% offers provide. I think at most what we're probably looking at is maybe some tougher qualifications in order to earn that 0% offer, or maybe lowering of overall time frames that the 0% are good for. So maybe instead of, 12 months, everything gets brought back to 9 or 6 or lower. That's probably more realistic than just flat out getting rid of 0% offers altogether. Now, before you panic, stick around for the end of this video, because even if 0% offers get harder to get a hold of or terms get shorter, I'm going to show you how to get around that so it's not going to impact you directly. So as sort of a side item to the 0% offers that we've been talking about, recently a lot of consumers are seeing their established credit lines decrease, and understandably, they're getting a little concerned about this. So what does it mean when that happens? Are the banks themselves struggling and that's why they decreased my limit? Well, let's think about this for a minute. With a loan, the banks are immediately giving you that money outright. It's just out of the building now. The moment the loan is approved, the bank is out of that money, right? Now, that's not necessarily the case with credit cards or business credit cards. So instead, they give you an amount you can spend up to when they issue the card. They aren't out anything right then and there. So whatever you spend, that's the money going out the building. So if you're seeing a decrease on your statement, it doesn't really have anything to do with the bank struggling and has to pull in all this money again. Realistically, it has more to do with you as a borrower, your spending habits, your repayment history, your overall relationship with that bank. So how do you make sure your limits don't get decreased? Well, let's start with the first point. Your spending habits. Do you max out the card the second you get it? Do you never use the card and that credit limit's just sitting there? These factors impact how risky of a borrower you are. And if the banks see you as risky, they're going to want to decrease that risk as much as possible. So instead of sending you on a crash course of, hey, here's how you should be spending your credit, instead they just go, let's just give them less credit. Now, on the other hand, if you use the card regularly and you're avoiding maxing it out, but you only ever pay the minimum payment, That's also frowned upon by the banks. The banks want to see that you can repay what you're spending, and sometimes only paying the minimum payment can set off warning alarms that maybe you're in a tough spot financially. Even if that's not the case, the banks are going to assume the worst. And therefore, banks want to decrease their risk, so they decrease your limit. Now, one more thing to keep in mind about initial offers from the banks are existing bank relationships. This is huge. According to a recent report, a majority of US adults maintain the same primary checking relationship with a bank for 14 years on average. People are not usually jumping around from bank to bank. So, to really illustrate how much of a difference existing relationships can make on bank decisions, let's use an example. So let's look at two different Fund&Grow clients who are looking to get the same 0% APR business card from Chase, okay? So first one, we're just gonna call client A. They've got a checking account for personal and business, plus a couple of savings account with Chase. So the bank kind of sees money is regularly coming in with them. They've had at least one open account with Chase for 10 years, and they have a personal credit card with Chase for 5+ years that has excellent repayment history. Pretty ideal. Now we're going to call this one client B. So they've got a personal savings account they just opened with Chase 30 days before wanting to apply. They don't have any kind of personal credit card with Chase already. Now they have other personal cards with good repayment history, and they haven't had like a late payment in over 2 years, but still nothing really concrete with Chase other than that savings account. So if you were working at Chase Bank and you had to choose between these two clients, which one received $30,000 and which one received a $10,000 approval, who would you choose for the bigger one? Who looks less risky to you? It's client A, right? Now, this example is not to say that you need to have 1 million open accounts with every bank under the sun, but it does show you that if you have the personal relationship, you are far more likely to receive the offers with the best terms and highest approvals. It's all about minimizing the risks for the banks. And client B can take that 10K card, and by showing excellent usage and payment history for 6 months, the bank may very well boost them up to a $30,000 or $50,000 card. But on the other hand, if client B immediately maxes it out and only pays the minimum, the bank very easily could drop that 10K limit down to 2K. Just like with business, it's about the relationships that you form with the bank lenders. Now, I said I was going to tell you how to still get access to these offers, even if qualifications tighten up. So let's touch on that for a minute. Number one, you want to ensure you are so perfect on paper that the banks can't turn you away. Now, what do I mean by that? I mean, review your credit reports before and get rid of anything on there that could give the bank a reason to not lend to you favorably. Make sure your entity is set up so the banks want to lend to you. Have a plan for how you want to use the funds to show you aren't a risky borrower if they happen to ask, and so on and so forth. Now, if you want to learn a little bit more about the tricks of the trade, I've actually left our free training for you in the description to walk you through all of this in greater detail. And all of this should help to prepare you if things should change more drastically. But just as a quick recap, the banks make money extending 0% offers, so it's highly unlikely that they're going to discontinue them anytime soon. If you're seeing decreases in your limits, it's time to look at why. What are your spending habits? Are you more like client A or client B? Are you paying more than the minimum each month? Answering these questions and utilizing the tips that we've talked about here is going to help you navigate through any changes that may come up in the future, even in this crazy economic climate. So, I hope that's helped answer your question. Again, thanks to Joe for the great comment suggestion. And if you've got any suggestions or anything that you want to know more about in terms of banking, credit, business, whatever the case may be, feel free to leave us a comment below, and we'd be happy to explore these options with you in the future. For everybody here, I'm Zach Ritchie at Fund&Grow. Thank you so much for joining us. I'll see you next time.